Well, we're keeping an eye on the bond market, even as the Dow and S&P 500 on track to close at new highs. Yields are jumping for the sixth day in a row. The 10-year now hovering just above 4% over the last couple of days. For more on this, we're joined by Steve Laipply, BlackRock Global, co-head of bond ETF. Steve, great to have you on here. So I want to focus on what we're seeing in the bond market first, and then we'll get to how that is playing into ETFs, because we're seeing the 10-year above 4% over the last couple of days, even on the heels of these Fed minutes. What does that tell you about how the market is pricing in or pricing out any potential economic weakness moving forward?
Well, Madison, thanks for having me. Yeah, look, there's been quite a lot of debate since that very strong payroll number that came out. There's debate around that number itself, in terms of whether the statistical adjustments will lead to some sort of a revision down the road. But no doubt it was a strong number and alleviated some concerns about, a hard landing scenario. So you've seen the market respond to that. You've seen, the larger cuts get taken out of the market for the rest of the year. Right now, if you look at where futures are trading, you're seeing a couple more 25 basis point cuts, another, around 100 next year. And, for this next cut in November, there's, it's still hovering around an 80% chance, not a 100% chance that you get that 25 basis point cut. The minutes revealed, as your prior guests talked about, some debate around whether 50 or 25 was appropriate. So there's just a lot of chatter in the market. People are really trying to size up exactly where we are and how the Fed's going to respond going forward. I think the important part here is that if you look back a year ago, we were at 5% on 10s. We're at 4 now. It is still not too late in our view to actually move into the bond market. We still have trillions sitting in cash. So it's going to be really hard to finesse this exactly right. But we do think investors should probably, size up their fixed income allocation at these yield levels. If anything, it's an opportunity at this point.
So let me ask you, Steve, when you look at the benchmark 10-year, you are peaking, so 4063, where do you see that heading near intermediate term here?
Well, it's interesting. It's a little bit of deja vu, not at the same level, but we did see some technical pressure last October as well. And I think right now we do have a very big number coming out tomorrow in terms of CPI. We'll see where we are after that. I think that if you get a weak CPI number, you obviously would see a bit of a pullback in these yields. In absence of that, if it's sort of a middling number, I think yields are probably going to be bouncing around here, give or take. There's probably a little bit of technical pressure. There is some, short base that's kind of developing in the market. So you could see it maybe grinding a bit higher. I don't think we're expecting a wholesale jump in yields unless you get a really nasty inflation surprise.
Well, it's interesting because you talked about how investors should size up their fixed income allocation at these yield levels. Is that the case for all investors? And I specifically want to get your take on retail investors, because that's a primary part of our audience here at Yahoo Finance. What should they be thinking in terms of positioning within bond ETFs specifically?
Yeah, so we've started to see this. Most of the flows this year, we've seen a record amount of flows this year. We blew past the 2021 number as an industry. At iShares, we just crossed $1 trillion in bond ETFs. Year to date in the US, we've taken around $75 billion. Most of that is in broad, high quality fixed income. So think of the ag, things like that. You then have quite a lot of allocations to treasuries, believe it or not. That's spread around the curve from anywhere from TLT, the longest, all the way down to SGov, which is the T-bill fund. I think the big message here is that investors are still largely underallocated to fixed income. So, the 60-40 is certainly not right for everybody, but if you think of that as just sort of a stalking horse, investors are fairly underallocated to fixed income. Still at this point, a lot of investors are sitting in cash on the sidelines. So, I think at this point, if investors are still a little bit hesitant because of the volatility in yields, we think just at least stepping out of cash into, kind of the intermediate part of the yield curve, there's reasonable value there. So, again, think of these kind of belly exposures like the ag or sort of, 5-year treasuries, things of that nature.
Steve, when you talk about these record flows, I'm just curious, we have line of sight where that's coming from. Is that retail, institution, both?
Yeah, I think overall, like longer term, buy and hold flows tend to be more retail. But I do think there has been a healthy amount of institutional flow here. we've seen several stories about large institutional investors using bond ETFs to position. And interestingly, in treasuries, the treasury market is still a fairly liquid market, but more and more we're seeing even pretty large, sophisticated institutional investors using bond ETFs, even in things like treasuries and mortgages, to position duration, very tactically as we move in and out of these data cycles, as an example. But yeah, I think it splits buy and hold tends to be more retail, but you do see a lot of tactical positioning by institutions using bond ETFs.
Steve, always great to have you on the show. Thank you for joining us.
Thanks for having me.